Right, next up we've got Rafi from Sasfin Asset Management. Rafi, I just want to check there you are. Sorry, I'm looking in the wrong direction. Thank you so much for being here.
Thank you.
Appreciate your time.
Afternoon, everyone. My name is Rafi Rutstein. Don't know where that is. Oh, there we go. I'm one of the portfolio managers at Sasfin Asset Managers, and I'm sure you're all familiar with Arno Lorenz, who's our Chief Investment Officer, who manages the funds that we'll be focusing on, which is primarily our flexible income fund and a little bit our high yield fund. But when you're preparing these presentations, and BCI really wants us to have these in weeks and weeks in advance, it's always hard to try and find something that's topical, that's relevant, and that will still be relevant 3 weeks later, especially in this ever-changing environment that we have in South Africa. So I thought something that's really been top of mind over the last while is the SARB's push to change our inflation target a little bit lower to 3%. And I thought maybe to focus a little bit, therefore, on inflation and what the prospects are, just as one lever in fixed income as to what that impact and outlook will be. So I'll start off with something personal. This is actually some cookbooks that my grandmother, who was a famous chef, at least in the Jewish community in South Africa, happens to have published in 3 different languages. I don't know if any of you in the audience might have known her. For 3 or 4 decades, she was probably the go-to caterer in our community, and happens to be that when she retired, I think she was the first woman who was ever admitted into the British Chefs Association. I never even know what it is, but the first female ever to be admitted into that prestigious organization and association. And when she retired, having managed, together with my grandfather, an extremely successful catering business, she retired a millionaire in dollars. Even when my grandfather passed away now almost 20 years ago, they still had more than $1 million in assets and savings. And just because of the cost of inflation, and she should live and be well, she's already well into her 90s, with advancing health issues, the need for full-time care, needing to live in an assisted facility for elderly, that savings has dwindled to the point where us as a family are now considering where to next and how much does she still have left of those savings. And so much of what we do in asset management and so much of our purpose with responsibility, with taking appropriate risks at the appropriate time, is to try and ensure that our clients, as they age and as they get older, can save for retirement and live with dignity into their old age. And as longevity increases, this is becoming more and more of a challenge, that we have to make sure that we can grow our clients' wealth at above inflation. And this is just random things. How impactful is inflation? So I don't know if anyone can see some of those prices, but I happen to find, thanks to Google, a few ads from 1980. I mean, it's amazing how resilient some of the brands are that we have in South Africa. You've got your All Gold, your Recoffee, your Sunlight Liquid, but can you imagine paying less than R1 for a bottle of dishwashing liquid? And now today, the same thing, and this is the specials page. On special, you're looking at something that just from then, cumulatively, is 4,000% more expensive on average than what it was in 1980, which is an increase of 9% per year, effectively in terms of the cost of living on a day-to-day basis. Similarly, the cost of cars, if you look at a somewhat entry-level, not even the entry-level, but one of that go-to sedan as an entry-level car in South Africa, which once cost you 100,000 Rand, is now going to cost you over 500,000 Rand for an equivalent vehicle. Again, an increase in price of 8% per year on average. And one of the things, as the SARB flagged in that working paper that they did in terms of the benefit of reducing our inflation target, is that when your cost of manufacturing and your cost of goods increases so much, if you actually look at it, the cost of inflation or the increase in inflation in terms of how much goods have gone up has actually gone up more than the currency has depreciated in that same period of time. And as a result, us as a competitive manufacturer and exporter of these goods is actually becoming less and less and less, because at the end of the day, it's becoming more and more and more expensive because of the labor costs and the input costs and the electricity costs to manufacture these same goods. So that, as I heard from NAMSA earlier in the year, Morocco is soon going, or has already, I haven't actually looked recently, Morocco will soon overtake South Africa as the largest exporter of vehicles on the continent. And because we're just becoming less and less competitive, even when we can produce and manufacture, but it's becoming too expensive that it's not even worthwhile, even with our currency as weak as it is, for people to choose us as a preferred manufacturer and exporter. We know that inflation has trended lower, certainly over the last period since 2021, and really as inflation, as you can see, that it's trending down there at that 3%, it has ticked up a little bit, really was the impetus for the SARB to say that now is the time and the opportunity that maybe we should shift. And we know that they announced, even without all of the consultation and maybe commitment from their other partners in terms of National Treasury and the Finance Minister, that now is the time to try and make that move because inflation has come down so much. And the question, I guess, that we wanted to ask or pose is how likely is it, or how quickly is it, that the SARB will be able to actually achieve this target? I mean, in the meantime, we're still seeing, when it comes to wage negotiations, labor negotiations, that people are still, as their first ask, is to request 8, 9, 10%. And until we're going to see that your go-to in terms of how much of an increase you need for the next year is going to be closer to that 3% level, it probably is going to be very hard to achieve a 3% target. When NERSA comes around and says, I'm sorry, we forgot, we actually needed to give you an extra 54 billion, and we'll just pass that on to the consumer, and administered prices are so high, how challenging and how easy will it be for the SARB to reset those expectations and actually, yes, get us to that 3%? So what I've shown over here is the last time the SARB announced that there was going to be a reduction in our inflation target from that 3 to 6 band and explicitly target 4.5%, it took us approximately 2.5 years for those expectations and perceptions out there to actually accept that 4% is the correct level of inflation in our economy. And I guess now the question is, how long will it take going forward? The SARB maintains that they've achieved so much credibility because of this 2.5-year period to get to 4.5%, that before you know it, it should just take a year. But the reality is that until these things pass through and actually are achieved, maybe it does take 1.5 years, 2 years, 3 years. And part of what Phil was saying, that actually bodes extremely well for fixed income, as I'll touch on a bit more. 29th of May this year is when the SARB actually announced that they were reducing the inflation targets. I've just shown over here how much have bond yields compressed since then, since that announcement was made. And this is just the period between the end of May and the 31st of August. As of today, the all bond index has returned 13% or thereabout. 9% of that return has been generated since the 29th of May. So what I'm pointing out over here, these pink lines, is that you can see up until the 29th of May, the front end of the curve, because we were getting some rate cuts coming through, were a little bit stronger. But across the curve, you're really seeing, since that inflation target was implemented by the SARB, that there's really been quite an aggressive shift downwards of yields on our curve that's resulted in tremendous capital gains for all those who were lucky enough to be invested during that period. And so going forward, what do we expect? This before May, if you would have looked at the same chart, the expectation was that the interest rate cycle and the cutting cycle would bottom out at 7%. At this stage, the SARB is saying that if your neutral interest rate is 2 to 2.5% above inflation, that we really should be able to get down to 6%, if not lower. At least now the market is beginning over the next 1.5 years or so, or 2 years, to factor in that we'll at least get 2 more interest rate cuts over the next while. Maybe not this week on Thursday when they meet again. I guess it might depend on what the Fed does. But certainly going forward, there is certainly scope. And as the SARB trends towards that 3% target, that we should be able to see that interest rates should come down meaningfully closer towards that 6% level. And doing like a back of the matchbox calculation, assuming that that would be correct, as Phil said, not everything is still priced in. There's a lot of gains that there are still to be had in the fixed income space. There's a lot of political, economic reform. I don't know if any of you have seen, Black Leadership South Africa has created a reform tracker on their website where they look at across the spectrum, economic reform, governance reforms, judicial reforms in the country, and they pointed out in their last quarterly newsletter that the pace of those reforms are at their highest that they've been in quite a long time in terms of the momentum of those reforms taking place in the economy. And as Phil pointed out correctly, that bodes exceptionally well that probably towards middle to end of next year, we'll be beginning to talk about whispers of ratings upgrades and slowly, maybe, hopefully, taking that path towards or getting up out of that junk status. And if that's the case, all I've done is say, if we would look and say that we'll have another 0.5% reduction in bond yields for the entire all bond index, at this point, over the next year, what will your return be? And that should be around 12%. If we can even have 1.25% of a reduction in yields over that same period, that gives you a return of 17%. And our argument is that if the SARB, geopolitics is what it is, and there's so many other factors out there that we can't control. But the GNU has been a godsend and a blessing that none of us could have expected, and yet we are seeing these reforms take hold, and the positivity around South Africa picking up and increasing exponentially more than we could have ever imagined. Vulindlela's contributing significantly. Reforms across municipalities seem to be picking up momentum, hopefully. Emphasis on water infrastructure, logistics, and the like. The deregulation of the electricity sector, and hopefully that then follows through into logistics as well and help Transnet recover. All of these are positive tailwinds and momentum for the fixed income space. And because of that, 17%, so these are based on numbers that a lot of analysts have spoken about, where you'll see a re-rating of our curve downwards, 0.5 to 1%, which I think speaks to the fact that especially if it's going to take 2-3 years for the SARB to achieve this target, we should expect, all else being equal, that we're kind of in the throes of a sustained bull market in bonds that should be able to achieve exceptional returns. At Sasfin, just to touch briefly, we have 2 flagship funds, and in the context of this presentation, I really want to focus on our flexible income fund, where we try and achieve bond-like returns with less volatility. We happen to also have a high yield fund, which is a bit of a misnomer, but really it's a stable income, enhanced income, enhanced cash type of product, which gives you about 2% above market, above money market, typical type of funds. But the point is this, and this I just want to focus on, as we come back to this inflation story and the need to invest in such a way that we're able to achieve above inflation returns for our clients, just to point out that our flexible income fund, because it benefits from having those capital gains and doesn't just accrue interest, but does, because it's invested in fixed bonds, is able to achieve capital gains on top of it. Our high yield fund, which is really just accruing income at a high level on a monthly basis, both of those funds have well outperformed and exceeded returns relative to inflation. So that 3.5 was the last inflation print. But over the last year, you've gotten, even in our high yield, which is really a conservative, well-diversified income fund effectively, has given you 6% real returns out of this asset class. And if you're prepared to take that little bit extra risk, 7.5% real returns, which is just fabulous if you're investing for the future and for your clients. And to point out that, like this is one of the slides, we try and be exceptionally transparent in terms of the risks that we take within our portfolio. And, sometimes one can maybe make speculative bets or try and do things that are a little bit risky. But one of the guiding principles in terms of how we manage money, and certainly with Arno at the helm, and a strong credit risk department with Ringatani and Blovo as our head of credit risk, and which everything that we invest in has to go through that credit risk process, really speaks to the fact that, as you can see, and this is the current makeup of our fund, that we're sitting in a fund where almost 80% of the fund is invested in AAA rated instruments on a look-through basis, which is a very high quality fund. And even that A-, as you can see, is the bottom of that spectrum in terms of the credit risk that's in the fund, just on a credit rating perspective. And there's numerous other slides that we show that speak to this, but that's generally the theme across all of our funds, that it's well diversified and very, very consistently investing in high quality credit in order to achieve those returns. And as a result, cumulatively, the fund, since its inception, as we just show over here, which is this darker blue line coming up over here, that it has well outperformed peers, benchmark, the all bond index, as an actively managed fund, we really do move and shift the composition of the fund through time and through cycles in order to try and achieve the best risk-adjusted returns that we can. And amazingly, since the fund's inception just over 10 years ago, this fund currently ranks as the top performing fund in the multi-asset income category of the market. And that's just another idea just to show you that same theme, that the fund is able to achieve those higher returns at less risk. And just another slide, just that I'll finish with this, just as I see time is running down, but that the capture profile, which is how much or how actively managed is your fund relative to a benchmark, just to point out that when it comes to upside return and capturing the upside that is earned in the all bond index, when we compare our fund to the all bond index, 80% of we are able to capture 80% of the upside, whereas on the downside, we only pick up about 10%. And that dynamic, because of the active nature of how we manage the fund, is really what drives those positive returns through the cycle. I'll pause over here.
Thanks, Rafi.
There you go.
Good to know a little bit more about your family. I'm definitely going to look for that cookbook. Maybe you've got a copy for me and I'll buy it from you. Very quick question, and I mean, inflation-linked bonds have been very topical for the past 18 months. Entry points for inflation-linked bonds, a lot of people seem to get that wrong. Inflation-linked bonds in your funds, do you use it? Is this the time to add more?
So it is a difficult asset class. Typically what you find is that inflation-linked bonds rally after nominal bonds have already rallied. So, I mean, currently we did, going into with all of the geopolitical risk that we had, we did allocate some of our fund to about 3.5%, 4% to shorter dated inflation-linked bonds. Currently, because of just seeing how much nominal bonds have rallied, and actually, I don't actually have to check the numbers, but I know over August, linkers outperformed nominals, if I'm not mistaken. Certainly July it was the case, that we have added a little bit of linkers into our fund at the moment, and hope to capitalize on the capital gains that will come from that as the curve shifts lower and inflation begins getting priced out of the market.
I will leave that in your capable hands. Someone's going to try to time that, and I'll give it to you.
Thank you.
Thank you so much for your time. We really appreciate it.